Hey everyone, welcome back to the channel. In today's video, we're diving into a topic that's on everyone's mind right now, the global stock market crash this year. From rising interest rates to geopolitical tensions, there are several factors creating a perfect storm in the financial world. In this video, we'll break down the 7 reasons that lead to a market meltdown and explain what this means for your investments. So, if you want to stay ahead of the curve and understand the risks on the horizon, make sure to stick around. Let's get started. Number 1. Rising interest rates. Rising interest rates are a significant factor that lead to a stock market crash. When central banks, like the US Federal Reserve, raise interest rates to combat inflation, borrowing costs for businesses and consumers increase. This reduces spending and investment, leading to lower corporate earnings and stock valuations. For example, in the United States, aggressive rate hikes in response to high inflation have caused investors to reassess the value of stocks, particularly in high-growth sectors like technology. As borrowing becomes more expensive and economic growth slows, the likelihood of a market downturn increases, contributing to global financial instability. Number 2. Persistently high inflation around the world. Persistently high inflation has been a major factor contributing to stock market instability worldwide. As inflation erodes consumer purchasing power, demand for goods and services declines, leading to lower corporate earnings and falling stock prices. For example, in Argentina, rampant inflation has led to sharp devaluations in its currency, causing investor panic and a significant drop in the stock market. Similarly, in Turkey, soaring inflation rates have forced the central bank to hike interest rates, further straining the economy and leading to a sell-off in Turkish equities. These examples highlight how unchecked inflation can disrupt markets, trigger investor fear, and contribute to a global stock market crash. Number 3. Geopolitical tensions. Geopolitical tensions are a significant factor that trigger a stock market crash, as conflicts or instability in key regions can disrupt global trade and investor confidence. For instance, the ongoing conflict between Russia and Ukraine has led to severe disruptions in energy and food supplies, driving up inflation and creating economic uncertainty worldwide. This uncertainty often leads to a flight of capital as investors seek safer assets, resulting in sharp declines in stock markets. Additionally, tensions in the South China Sea or potential conflicts involving major economies like the US and China could further escalate fears, leading to a broader market sell-off as investors react to the potential for global economic disruption. Number 4. Economic slowdown in China. An economic slowdown in China significantly contributes to a global stock market crash due to its central role in the world economy. For instance, if China's growth falters, it can lead to reduced demand for commodities and exports from other countries, causing economic distress globally. As China is a major player in global supply chains, disruptions in its economy can ripple out, impacting international trade and investment. For example, during China's property market crisis, a slowdown led to reduced consumer spending and industrial output, affecting economies worldwide. This interconnectedness means that a slump in China's economy can trigger a broad market sell-off as investors react to reduced global growth prospects. Number 5. Debt crisis in emerging markets. A debt crisis in emerging markets significantly contribute to a global stock market crash this year. Many emerging economies are heavily indebted, with substantial amounts of debt denominated in US dollars. As interest rates rise and the dollar strengthens, these countries face increased debt servicing costs, leading to potential defaults or financial instability. For example, Sri Lanka has been struggling with a severe debt crisis, resulting in a default on international debt payments and severe economic consequences. This crisis not only threatens Sri Lanka's economy, but also raises concerns about financial contagion, as investors worry about similar problems in other emerging markets. The resulting loss of confidence triggers widespread sell-offs in global stock markets exacerbating the financial turmoil. Number 6. The unwinding of the Japanese yen. The unwinding of the Japanese yen is a key factor that triggered a global stock market crash this year. For decades, the yen has been a low-interest currency, attracting traders to borrow it cheaply and invest in higher-yielding assets, such as U.S. Treasuries. This created significant profit opportunities as the yen weakened against the dollar. However, Japan's recent interest rate hikes to combat a declining yen have reversed this trend, strengthening the yen and weakening the dollar. For example, if investors borrowed 1.3 million yen to invest $10,000 in U.S. assets, a stronger yen now means they need more dollars to repay the same amount, leading to losses. As traders scramble to cover their positions, massive sell-offs in global markets, contributing to a stock market crash. All of this accumulated into a rather large, abrupt sell-off. The thing causes a lot more fear, which causes an even bigger sell-off, which causes a lot more fear, and the cycle repeats itself. Number 7. Investor sentiment and market speculation. Investor sentiment and market speculation significantly contribute to a stock market crash. For instance, in the US, fear of a potential recession can cause investors to become increasingly risk-averse. This fear often leads to a wave of selling, as investors pull their money out of the stock market to avoid losses. For example, if there's widespread concern about an economic slowdown, investors might start selling off stocks in anticipation of lower corporate earnings. This collective action can drive down stock prices sharply. Additionally, speculative bubbles, such as those seen in tech stocks or cryptocurrencies, can burst suddenly, leading to panic selling. When investors realize that valuations are unsustainable, they may rush to exit their positions, exacerbating the market decline and potentially triggering a broader crash. So, there you have it. 7 critical reasons that potentially lead to a global stock market crash. From rising interest rates and persistent inflation to geopolitical tensions and economic slowdowns in major economies, the current landscape is full of risks that could shake up financial markets worldwide. It's essential to stay informed and consider how these factors might impact your investments. While no one can predict the future with certainty, understanding these risks can help you make more informed decisions and better prepare for potential market volatility. Thanks for watching. If you found this video helpful, don't forget to hit the like button and subscribe to our channel, Money College, for more insights and updates on the financial markets. Share your thoughts in the comments below. What do you think will be the biggest factor impacting the market this year? Stay tuned for more content, and I will see you in the next video.